With just $100 a week, it is possible to build an investment portfolio capable of eventually replacing a full-time paycheck. This approach is not based on speculative assets like cryptocurrency, but rather on SCHD, the Schwab U.S. Dividend Equity ETF, a fund that has consistently outperformed the broader market for more than a decade. Delaying investment only increases the long-term cost, while consistency and time are the true accelerators of wealth. The SCHD ETF offers exposure to high-quality U.S. companies known for their reliable and growing dividend payments. Rather than chasing volatile trends, SCHD investors benefit from steady, long-term income through ownership in established firms such as Texas Instruments, Amgen, and PepsiCo, which currently yield approximately 2.9%, 3.5%, and 4% respectively. These dividends are not one-off events. These companies have a proven history of increasing payouts annually, leading to a dual compounding effect. Portfolio value grows, and so does the income it generates. Historically, SCHD has delivered an impressive average annual return of 12.83% over the past 13 years, including reinvested dividends. This significantly exceeds the average American wage growth of 3 to 4% and vastly outperforms typical savings accounts offering under 1%. Unlike individual stocks, SCHD holds over 100 companies, offering diversification and reduced volatility. Its disciplined structure delivers regular quarterly dividends, and reinvesting those dividends helps increase share count, which in turn boosts future dividend income. The strategy depends on the principle of compounding, not speculation. Consistent, automated contributions drive the growth of this portfolio, requiring no market timing or stock-picking expertise. Investing $100 weekly amounts to approximately $5,200 annually, a figure attainable by making minor lifestyle adjustments such as dining out less frequently, canceling a streaming subscription, or reducing impulsive purchases. After the first year, assuming SCHD's historical return, the portfolio may grow to around $5,600. Though the initial gains may seem modest, this is the beginning of compounding. By year 5, total contributions of $24,000 can grow to approximately $35,000, producing about $1,200 per year in dividend income, equivalent to over 1 week of labor at minimum wage. By the 10-year mark, contributions totaling $52,000 could grow into a portfolio worth approximately $150,000. By year 20, $104,000 invested may yield around $1 million, and by year 30, with total contributions of $156,000, the portfolio could reach approximately $6.7 million. Throughout this period, all dividends are reinvested to maximize compounding. This illustrates that time and consistency are far more valuable than market timing or chasing high-risk opportunities. The first few years may feel slow, but over time, growth accelerates exponentially. The transformation is significant. After 5 years, a portfolio generating $1,200 annually in passive income may cover small recurring expenses. After 10 years, $5,000 in annual dividends could pay for several months of rent or even a used vehicle. At the 20-year mark, the portfolio could generate over $35,000 annually, enough to cover major living expenses and potentially support a transition to part-time work. By year 30, the portfolio could produce over $230,000 annually in dividend income, offering complete financial independence. This strategy is not about the size of the numbers alone. It is about what those numbers unlock. As the portfolio grows, money begins to cover life's necessities and eventually enables total freedom from traditional employment. The power lies in the system's simplicity and the investor's discipline. The main obstacle is not market performance but mindset. In the early years, progress may seem slow, and many investors give up too soon, distracted by trendy stocks or attempts to time the market. Successful investors resist these temptations. They stay committed, understand the value of delayed gratification, and maintain consistent contributions regardless of market fluctuations. Each share of SCHD represents a small stream of income. Reinvested over time, these streams multiply, exemplifying how true wealth is built through ownership, compounding, and a long-term perspective. Common mistakes to avoid include trying to time the market, reacting emotionally to news, stopping contributions, or abandoning a proven strategy in favor of high-risk plays. This approach requires thinking like an owner, not a consumer. With that mindset, emotions no longer control financial decisions. Instead, the money begins to shape the future. If $100 per week can build financial independence in 30 to 40 years, that timeline can be accelerated. Increasing weekly contributions early on, even modestly, can significantly reduce the time needed to reach financial freedom. For example, raising contributions from $100 to $150 per week could grow a portfolio to approximately $10 million in 30 years, generating over $350,000 annually in dividend income. Even increasing to $125 per week may allow the investor to reach the $1 million mark 3 years earlier. This strategy becomes even more critical for those starting later in life. Someone beginning at age 40 might not have 30 or 40 years to compound, but by contributing $200 to $250 weekly, it is possible to compress decades of growth into 15 to 20 years. Leveraging salary increases, bonuses, or side income to boost contributions early on provides a powerful acceleration effect. Each additional dollar invested now reduces the need for future labor and brings the goal of financial freedom closer. This method does not require an overhaul of one's lifestyle, only smarter allocation of resources. The outcome is a shorter path to independence, fewer years working for money, and more time to focus on what truly matters.